It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Karl Berger. He's our featured guest of the morning. He's also senior wealth consultant and investment counselor at Cidel Asset Management. Timing the market. I get, when I speak about investing with people, a lot of them are, they want to buy low and sell high, and they think that at least some effort to time the market is what they should be doing.
We like the idea of buying low and selling high too, but not from a timing the market notion. And we've had this conversation a number of times over the past decade or so, and we'll probably continue to, Paul, because I think it's really, really important for investors as a whole to control what they can control in terms of how they're deploying their capital. And obviously you can control when you put your money in and when you take your money out. But if you're doing it based on emotional factors, if you're doing it based on a fear of what might happen, if you're doing it based on you think everything's great and this is going to happen, those aren't really decision-making tools that are based in any kind of logic or anything that you've got control over. Mm-hmm. So we're getting a lot of questions these days about the market having run up as much as it did in the last 2 months, and is this the time to deploy capital?
Right.
And I'll plainly tell anybody that asks that question that I don't know what the next 2 months or 3 months or 4 months brings. What I do know at this point is that we are at the end of the monetary policy tightening cycle. Right. I don't know whether the market has now priced in too much easing in the short term, but I think I'm pretty safe in saying that by the end of 2024, rates are going to be lower than they are now. So markets should have a bit of a tailwind from that. All of that focus is to keep people from focusing on how much markets have gone up or down in a period of time and concluding that that means that it's time to either buy or sell, and to instead focus on allocating into good companies that are going to generate a lot of free cash flow over the next 2, 5, 10 years. 2023
was a pretty good example, wasn't it, of why you shouldn't try to time the market. When 2023 began, I don't think a lot of people thought that the S&P 500 would be up 19 or 20% by the end of the year, and the NASDAQ composite would be up some 40% by the end of the year. There was a lot of gloom about rising interest rates and the possibility of a meaningful U.S. recession at the beginning of 2023.
Yeah, so 2023 is a great example of this. I state it slightly differently than that. There was certainly some optimism that at some point during 2023 monetary policy would shift. The way 2023 started out, the first quarter was very, very robust. People got very disappointed during Q2 and Q3, and it really wasn't until the end of October when the Federal Reserve pivoted that markets went up. But it was that middle period where people were disappointed with the lack of progress, and where if you were trading based on emotion, it would have been very, very easy to say, look, why can't I'm much better to be earning 5% in a GIC or 5% in a near cash instrument, because my portfolio's up nothing to begin the year after being down in 2022. I just want to have that safe 5% return. And of course, for anybody that did that, they missed out on the rally that happened after the end of October, and they may still not be invested now. And that's the other aspect about market timing that is so incredibly difficult. I can totally understand how it feels very, very safe and secure to be invested in a 10-year bond right now that's yielding 4.5%. Yeah. You know what it's going to do. There's not going to be a whole lot of volatility. And I think for fixed income over the next year, the risk-adjusted returns may very well be better than in the equity markets. But that's not a given, and it's very difficult to get back into the equity markets if you've been out of it and stocks have rallied. Yeah.
What about on a stock-by-stock basis? This isn't really market timing, I don't think, but what about, for instance, waiting for a pullback in shares of Microsoft if you want to initiate a position there or add to an existing position?
Yeah, so to me, that depends on a stock-by-stock basis with where a company is in what we would call their valuation range. We expect Microsoft to make X amount of money over the next 10 years in incremental flows. What's that worth? If we think Microsoft is worth somewhere between $300 US and $375 US based on the range of the amount of money that we think they'll make in the next 10 years, and if they're trading at $360, well, absolutely, it's worth waiting for a pullback, because you're so close to the top of your best case valuation range. If it's trading at $310 and your range is $300 to $375, there's probably less reason to wait, because at that point you've got far more upside than downside, assuming that your analysis is correct. So to me, it's very qualitative in that regard.